Imagine standing at the mercy of a storm, equipped only with a barometer indicating atmospheric pressure but no direct indication of when or where the storm will hit. In financial markets, option traders face a somewhat similar situation, navigating uncertainties not with a barometer but with a crucial, somewhat nebulous figure known as implied volatility. This measure, derived from the prices of options themselves, offers a forecast, not of weather, but of the potential magnitude of stock price movements. The reliability of this forecast, however, is as debatable as it is essential, entwined deeply with the fibers of modern financial theory and the tumultuous realities of trading floors. As the cornerstone of the Black-Scholes model, the most celebrated model in financial economics for pricing options, implied volatility reveals the market's expectations of future volatility based purely on option prices. This is not merely an academic point of interest. It underpins billions in daily trading, affecting decisions in hedge funds, investment banks, and private trading desks around the globe. Yet, despite its prevalence, the intricacies of implied volatility and its practical ramifications remain overshadowed by its complexity and the sheer unpredictability of markets. This essay ventures into the core of this financial enigma, exploring its theoretical foundations, practical applications, real-world implications, and the consequential limitations that shape the strategies and fortunes of traders worldwide. Implied volatility is an integral component of the Black-Scholes model, a mathematical framework for pricing European-style options. Introduced in the early 70s by Fisher Black, Myron Scholes, and Robert Merton, this model assumes that the stock market behaves in a log-normally distributed manner and that the volatility of the stock's returns is constant over time. Implied volatility, in this context, reflects the expected fluctuation in an underlying asset's price over the life of the option. Despite the pristine elegance of the Black-Scholes formula, the real-world scenario complicates its assumption of constant volatility. Implied volatility, extracted from the market prices of options, often provides a more flexible, nuanced view, adjusting for market sentiments, forthcoming events, and other catalysts that might sway the underlying asset prices unexpectedly. Understanding the discrepancies between implied and historical volatility is critical, not just for pricing the options accurately, but for strategic financial planning. While historical volatility measures past market behavior, implied volatility offers a forward-looking perspective, inherently containing more speculative elements. Implied volatility is particularly esteemed as a forecasting tool. Traders scrutinize patterns in this indicator to gain insights into possible future volatility and thereby infer the potential risk and need for protective measures in their investment strategies. In essence, it represents a collective consensus of where the market believes volatility will move in the future, based currently on options pricing. The implications of these insights are vast, influencing everything from individual portfolio hedging strategies to corporate financial risk management. For instance, a sudden spike in implied volatility can indicate growing uncertainty or instability in the market, prompting traders to adjust their positions to mitigate potential risks. Additionally, financial analysts use various metrics related to implied volatility, like the VIX, often referred to as the fear index, which measures the stock market's expectation of volatility projected by S&P 500 index options. Understanding shifts in the VIX can aid investors in predicting market sentiment shifts, essentially serving as a barometer for market stress. The journey of implied volatility through financial history is punctuated by several key events that illustrate its critical role in market dynamics. Notably, the stock market crash of 1987, also known as Black Monday, is a prime example where implied volatility surged, reflecting the extreme uncertainty and fear in the market. In the days leading up to Black Monday, traders witnessed an unprecedented rise in implied volatility, which should have been a warning signal of the rising market stress and potential crash. However, the predictive power of implied volatility was not fully appreciated or understood at the time, leading to catastrophic losses. Post-1987, the financial community began to pay closer attention to this metric, integrating it more deeply into risk management and pricing strategies. This event marked a significant shift in the use of implied volatility, cementing its place as a crucial indicator in financial markets. Despite its utility, implied volatility is not without its limitations. One intrinsic issue is its basis on the Black-Scholes model, which assumes market efficiency and continuous trading, ignoring the effects of market jumps or the discrete nature of trading. Moreover, implied volatility can vary for options with different strikes and expirations, leading to what is known as the volatility smile or volatility skew. These phenomena indicate that the market's assumptions of log-normal distribution and constant volatility do not hold, especially in extreme market conditions. Furthermore, since implied volatility is forward-looking, it can be excessively influenced by short-term events or sentiment, rather than underlying economic fundamentals. This can lead to mispricing of risk, particularly in tumultuous times when fear or euphoria can drive market behavior irrationally. Financial crises offer a fertile ground for studying the behavior of implied volatility due to the heightened uncertainty and rapid changes in market sentiment. During the 2008 financial crisis, for example, implied volatility indices like the VIX reached astronomical levels, indicating extreme fear and uncertainty in the market. This spike in implied volatility had profound implications for options, pricing, and trading strategies. Traders relying heavily on models based on historical volatility found themselves ill-equipped to handle the sudden shifts, leading to significant financial losses for those not adjusting to the increased market volatility. The crisis underscored the importance of understanding implied volatility not just as a numerical value, but as a dynamic indicator that requires context, specific interpretation, and a flexible approach to risk assessment. Implied volatility is not a static measure and varies significantly across different asset classes. For instance, commodities and forex markets often exhibit different volatility patterns compared to equity markets. These differences are primarily due to the distinct market drivers, such as geopolitical events impacting oil prices or monetary policy influencing currency values. Understanding these nuances is crucial for traders and investors who operate across multiple asset classes, as it affects how they hedge risks and structure their portfolios. Moreover, the liquidity of the underlying asset also plays a critical role in how its options' implied volatility is perceived. More liquid markets tend to have more reliable implied volatility measurements due to the greater volume of option trading, providing a clearer picture of market expectations. As financial markets evolve with technological advancements and increased computational power, the analysis and application of implied volatility are likely to become more sophisticated. The integration of machine learning and AI could lead to more accurate predictive models that take into account a broader range of variables. Future developments might also see more real-time analysis and application of implied volatility, enabling traders and risk managers to make more informed decisions quicker. Additionally, the exploration of implied volatility in alternative investment markets, like cryptocurrencies, presents a new frontier for both academic and practical finance investigations. Understanding and effectively leveraging implied volatility remains a cornerstone of modern financial strategy. It is essential for market participants to not only understand the theoretical underpinnings of implied volatility, but also to continually adapt to its real-world applications and limitations. Financial professionals should invest in continual learning and leverage advanced analytical tools to interpret implied volatility accurately, adjusting their strategies to align with market conditions and sentiment. Furthermore, the incorporation of robust risk management systems that account for sudden spikes in volatility can safeguard investments during turbulent times. In summary, while implied volatility is a powerful tool, it requires a nuanced approach that respects both its potential and its limitations. By staying informed and adaptable, market participants can better navigate the complex and ever-changing landscape of financial markets.
Let's walk through a real-world example to better understand implied volatility calculations using the Black-Scholes model. Consider a European call option with these specifics. Underlying price, S, Euro 50. Strike price, K, Euro 52. Time to expiration, T, 1 year, 365 days. Risk-free interest rate, R, 1%. Option price, C, Euro 2. Our goal is to find the implied volatility, sigma, that, when plugged into the Black-Scholes equation, matches the market price of the option. The Black-Scholes formula for a call option is, where NN represents the cumulative distribution function of the standard normal distribution. The values D1, and D2 are calculated as follows. To solve for implied volatility, we reverse the formula, a process typically involving numerical methods like the Newton-Raphson method due to the lack of a direct analytical solution. For a detailed walkthrough of the Newton-Raphson method, be sure to watch our dedicated video on it, already available for viewing. Using numerical methods, we estimate the implied volatility. Suppose it comes out to 10%. This implies the market expects a 10% volatility of the underlying asset. Let's look at a volatility smile graph that plots implied volatility against different strike prices, showing how volatility varies with option moneyness. This graph and our calculations shed light on how traders use implied volatility to gauge market expectations and price options accurately. Implied volatility, as you've seen, is a dynamic and complex aspect of market analysis. Understanding its nuances allows traders to make more informed decisions, reflecting the ever-changing market sentiments. Thank you for joining us on this deep dive into implied volatility. For more insights into the fascinating world of finance, subscribe to our channel, like this video, and watch our previous videos for more resources. Stay tuned for more episodes where we decode the mysteries of the financial markets.